LBR LBO Debrief.
The global growth is actually slow. Was actually slow in 2016, and to say how much slow it is actually we have to go slightly back in some of the periods where we have actually seen similar kind of growth. So the growth today in 2016 is actually very close to what we have seen during the East Asian crisis days, or during the dot-com bubble boost, or even the period just after the global financial crisis. So those were the crisis days in which we saw growth similar to what we are seeing today. Yet today there is no crisis at all. The world economy seems to be doing fine, with the monetary actions and monetary policy being the keyword what we have today. This actually represents the map across the globe, which shows the growth trajectory across what the globe is seeing. So the lighter the shade, the slower is the growth part. So obviously the Latin America comes out to be the worst performing region, but it's the developing economy which has been quite a bit of a disappointment across the period. So we at Standard Chartered at least believe the developed world will be growing close to 1.5% this year. But what quite stands out is the region towards the east, which is the Asia, which is dark green. Now this is the region which is actually showing one of the fastest growing region in the world right now, which includes Asia, China, which includes India, China, and ASEAN region. So in terms of contribution to the growth, what these countries are doing. So US is still a very large economy, contributes to the growth, but in growth is a flow number. And in today's world, while in 1990s, the US was the primary driver of the global growth, today it matters much less. So right now, US is not even the first, not even the second, and probably it's the third largest growth contributor to the world in 2016. And it is going to remain largely that way in the next 4 to 5 years. China remains the biggest region as a growth contributor to the world. Second is the ASEAN plus India region. This region itself is growing at a very fast pace. So combined, China along with Asia ex Japan and China. So these two regions combinedly contribute close to 2/3 of what the global growth is. So if the global growth right now is close to 2.5%, China plus ASEAN and India, these two regions contribute to close to 1.5 to 1.6% of the total growth in that number. While growth is a flow number, the combined GDP, nominal GDP is a stock number, and here still US is a major contributor. Now, but the dominance of China and India is normally increasing gradually over the decade what we see. So in 2005, while India and China combined contributed to 7% of the world's nominal GDP in dollar terms, this number is likely to go to as high as 24-25% in 2025. So over the next decade, we are likely to see quite a big dominance of India and China in the total GDP, world's GDP. Now, what we have seen in the last couple of years, and even in the period after the global financial crisis, we have seen a prolonged run of low GDP growth. Low inflation has been throughout, especially in the last 3-4 years. Plus, there has been a lot of cash injections, or also known as quantitative easing by the central banks. So central banks had been pumping in a lot of money to prop up the economy. So as a percentage of GDP, the balance sheets of most of the key economies, so US Fed, European Central Bank, and the Japanese Central Bank. In fact, the Japanese Central Bank had pumped in so much money that I have to actually put it in on the right scale rather than the left scale, because otherwise other two have been dwarfed. So it's something which has been there with little effect to the growth. Inflation across the world has slowed considerably, partly driven by the low commodity prices, and that's what we are seeing. So it's sort of have become a status quo in terms of growth normal, which we are seeing. Average trajectory for one of the largest economic growth in terms of trend line, which was probably 3% some time back pre-global financial crisis, have now, depending on estimates, have come down to as low as 1.5 to 2%. So the growth has slowed down, and two of the primary key reason has been while there has been a lot of monetary policy stimulus, the investments still have fallen. So this chart actually shows the difference in the investments as a percentage of GDP between the 2001 to 2007 period and then 2007 to 15 period. So there has been a consistent decline across the major economies in terms of investments which they have put in, which has in turn bleaked the outlook for the growth going forward. And also what we have to factor in is approximately 50% of the investment demand also comes from replacement and maintenance demand. So in a way, the investments have been down quite significantly, during this period, we have also seen the leverage of the world economies going forward. So some of the leading economies do stand out there, including US, Japan, China. But key number is bottom, which totally stands out is Japan, where the total debt to GDP has actually crossed close 400% of the GDP. So while in Sri Lanka, we keep harping on the fact that the debt is high at close to 75-76% of the economies, there are other economies which are much higher in terms of government debt at least. So in this, overall what we have seen is low global growth, central banks pumping money, low inflation. As a result, the yields across the markets have been low. Across the developed markets have gone down low. So nearly 70% of the total yields available in the world right now is below 2%. And 1/4 or nearly 24% of the total yield is actually in the negative territory. So the world is actually, it's a big disincentive for the financial savers. And the world has been looking for yields, because of which we have seen even in the last couple of years a good inflow to the emerging markets currency. Now, what does that mean? Is the things likely to change? Probably we were thinking so. The narrative of the slow growth, low inflation was actually getting entrenched until we have probably the inflation shooting up in the last second half of 2016. So base effect related to the commodity prices started fading away. We saw the recent bout of inflation coming just after the Fed elections in there, where we saw a spike in inflation trajectory in US. These are the market expectations for the inflations. Now, inflation at least in our forecast, is expected to touch close to 3% for both US and UK in 2018. Now, UK is primarily because of the Brexit and the commodity and the currency depreciation, and US again because of the reflationary policies expected after the Trump elections. Now, while these two are the economy, and another economy which has seen recent inflation is China, where the PPI has gone into positive trajectory after remaining in negative for quite some time. So these are the three economies which have seen inflation coming up. But overall, for the rest of the world, we don't see inflation still moving up. So it's likely to remain low in Europe, in the European Union at least. It's likely to remain in Japan. And even though there is a slight uptick, the inflation is likely to remain within most of the central banks' tolerance limits. So what does it lead to the quantitative easing or the cash injections part which has been done by the bank? So right now, at least what we saw in the previous slide was, apart from US Fed, which has become now less growth stimulatory in terms of cash injections, where the numbers have been flat, the European Union and the JJCB has already committed to high monetary policy and accommodation. So we expect at Standard Chartered, we do expect that the ECB quantitative easing will be extended in the December meeting right now, and Japan has already committed. So we don't expect any change in narrative in terms of significant change in narrative in terms of growth, inflation, or the quantitative easing which I have been hearing in 2017, which is what probably the survey just done before the before the start of the talks did indicate. But yes, the narrative will start changing in 2017 when the people will start factoring in higher inflation and growth, and we see how the world economy evolves under the new geopolitics system. Now, while the growth has been slow and the policymakers have been getting used to that slow kind of growth, it's not something which the people are quite ready to accept. At least that's what some of the elections and the exit polls done just before the elections did show. So while most of the people won't be aware of exact theorems of economics, people do feel intuitively how economics work. So economy in general was one of the key disappointing area pointed out by in just the pre-budget poll expectations. Another thing which has been defining apart from the slow growth in the last 1 year in form of Brexit and the Trump election has been the immigration and the story around the anti-globalization and the more inward-looking economies. So this was a theory which even turned out to be in the case of Brexit referendum, which we saw in June. So in Brexit, the key issue was again related to immigration, where the axis clearly shows that the total number of EU nationals which have come to UK had actually gone up significantly in the last 3-4 years. Migration was a key issue in there. So while US elections had Donald Trump went into the elections going against trade dynamics, trade agreements and immigration, UK election was more on immigration and taking back the control of the UK economy from the European Union. Now, a lot of these things have been explained in economics theory by the graph on the global growth, global inequality work done by the Branko-Milanovic theorem. So he has done some quite significant work on global inequality, which explains what's the current trend on the global inequality is and what is driving the geopolitics related to inequality. So the chart actually shows to the bottom the quintile in terms of the world income and world population, world income, while the y-axis is actually related to the growth in real income over the last 2 decades between 1988 to 2008. Now the chart has been updated for 2011, but the inferences remain more or less the same. So the bottom quintile of the world, which is actually the poorest, has been actually locked out of growth. So their real income has stagnated. The middle income of most of the countries have benefited out of the globalization which has happened. So most of the significant benefit has been taken by the fast middle income growth in the China. So that's basically the 45 to 65 quintile, which has seen significant amount of growth accretion. What is interesting is somewhere close to 80th and the 90th percentile. So this percentile actually belongs to the middle income group of the high income countries. So this is where the real income has stagnated. So as per the different surveys done, even in the US, the average real income, which is adjusted for inflation, has remained stagnant since 1970s. And for most of the population, actually, it has gone down. This basically says that the income for the middle income group in the high income countries have actually been stagnant, and most of the benefit has been in terms of what the monetary policy has been taken up by the 1% of the global rich. Now, this 1% is again quite diversified. It includes 12% of the US citizens and 5% of the British citizens among the total group. So there is a rise in inequality which is causing a bit of political issues and geopolitical trouble right now, which this graph actually beautifully explains. So what it does shows is that when Branko ends up saying is global inequality, actually when it increases too much, it becomes politically unsustainable. So what we have seen is the rise of in the Brexit, on the rise of Donald Trump, and even what we are seeing in the French elections right now, which is due next year, is the forces which are speaking more about national populism against globalization and doing the welfare of the local economy rather than the global economy. So while the global economy has benefited because of globalization, global inequality has gone down because of globalization. It's the intra-country where the inequality has gone up, and the politics, unfortunately, is within the country. So that's how the politics has been changing its words in the last few years, what we have seen. Most critical is the European Union region, where we do see a big impact of globalization coming in next year. Eastern Europe had its elections in last 18 months. Some of the key elections were in Poland, Slovakia, Hungary, and Bulgaria. And most of these elections, the Eurosceptic or against Euro parties have gained ground. In Bulgaria, in fact, the recent recent elections did vote for a pro-Moscow president, which is much more against Europe. So while this has been the story with the Eastern Europe in the last 18 months, the action now shifts to the Western Europe in the next year. Next week itself, we have two elections. So we have Italian referendum coming out on 4th December, and on the same day we have Austrian elections, presidential election. Now, the opinion polls, how much over we trust them, is showing that the PM Renzi-led constitutional reform will fail. He will end up losing, and the Five-Star Movement, which is the anti-Euro party, is gaining a lot of ground in Italy. Austria opinion polls do show the election of a Eurosceptic president. Now, it's in Austria, at least it's a ceremonial position, so not that significant. In France, it's critical. So France and Germany are the two key political regions in the West which do take the heavy lifting of the European Union. And France, we have elections in April, May. The first round of presidential primaries have already shown surprise, with the existing President Nicolas Sarkozy losing out in the first round of primaries. And what we believe, while the market is not pricing in any impact of any shake-up in Euro, the election or the victory, which the opinion polls are not showing in terms of National Front's Marine Le Pen, can be very cataclysmic for the European Union. So right now, the opinion polls don't show her a victory in the presidential run, and markets are not pricing in, but that's a key event. In Germany, again, the Eurosceptic parties are gaining ground, but they are far from forming any major parties. So European map will be quite interesting in terms of geopolitics in the next 1 year. Now, what does it lead to the overall globalization as such? So globalization as such, measured by various indices, did show that in its current form, it had peaked in 2009 and 10. So that's where, while some of the countries like India are showing significant opening up of the economy, but overall, at a global level, we are seeing globalization is going down. What it leads to for the trade. So these are the various trade blocks which are existing in the world today. So key being the NAFTA, the European Union bloc, the Mercosur, which is in the South America, and the ASEAN trading blocks. These trading blocks are close to 75% of the GDP. Now, TPP was so in terms of trade, how do we see the world moving forward? So till 2008, so from 1947 to 2008, it was the period when globalization was improving. The trade was going at a very brisk pace. So during that period, the trade was increasing at a CAGR of 10%. So 10% CAGR for 60 years is quite a good growth in trade. But what we have seen after that is the global trade growth has gone down to 1.3%. So trade has gone down. World economy has been looking for trade, especially the Asian economies, which has been looking for growth and trade. TPP was in discussion for close to 7 years before. Now it's more likely getting junked. Another trade agreement which is not shown here, but which is in already discussion for the last 3 years is the RCEP, which is the Regional Comprehensive Economic Partnership, which is in discussion for the last 3 years. It includes all these ASEAN nations, China, India, Japan, Australia, New Zealand, and South Korea. So combined, these 16 economies will have close to 45% of the global population. It's close to Sri Lanka, will have close to 40% of the world trade and 30% of the GDP. So it's something which will be of interest to the most of the South Asian economies and how this agreement shapes up. Good thing is this agreement is not as restrictive as probably the TPP was. Now, one thing which impacts everyone is the climate change. Now, climate change has been significant. In fact, this turn of the century has seen 10 of the warmest years we have seen in the globe, whatever the measurement we have. Sri Lanka falls in the middle vulnerability range, but it's something we have to be cautious about, because while the world has moved significantly because of the Paris deal, in terms of climate control, still a lot of work has to be done, and various analyses do suggest that a lot needs to be done to achieve what we intend to. Water is another issue which is actually plaguing not only most of the emerging and developing economies, it's actually impacting even the countries like US, Australia, and Spain. Now, very shortly on the Brent crude oil forecast. Now, our forecasts, SEB forecast, actually is on the higher side compared to what is across the different forecast agencies. But our forecast is actually based on the supply side coming down rather than the demand picking up. So while demand is picking up, we doubt about the sustainability of the demand, but it's the supply which is the key factor in there. So this year, our forecast is $46 per barrel, going up to 66 by the end of next year. So on the conclusion part, while we do expect that that's what normally economists do expect, that the world economy will slowly recover, there are serious risks going ahead. We have risks related to how Brexit and the global economy turns out. We have risk related to the US policies, how it happens, and we have risk related to how China manages its economy and currency. So, plus the leverage we already have. So we have quite a few of risks which can jeopardize the growth. At least even at the numbers what we see, what our forecasts have been, I can see clearly some downside risk there in India, slight adjustment in the US and Europe region. So what it all leaves for the Sri Lankan economy. So world is changing, and next year, while the narrative will change, there will be significant things to worry about the Sri Lankan economy. So one of the key reasons is how Sri Lanka manages its growth and exports when the world exports growth and trade is slowing. That will be one of the key questions to answer. Another key question to answer would be how the currency dynamics change in the coming course. We have already seen Vietnam lowering its currency. How does it impact Sri Lanka? It will impact Sri Lanka. So, plus, apart from exports, Sri Lanka is impacted in terms of currency because of the external debt it holds. So there is an impact on Sri Lanka. Plus, we have to see how the capital flight, because once inflation starts going up in the developed economies, the yields start rising. There is a chance that the capital actually starts moving back to the developed economies from the emerging economies. So we have to be wary of these things and see how growth and trade pans out in Sri Lanka because of what's happening out in the globe. Thanks a lot.
LBR LBO Debrief.